What I want to do before I kick off is welcome Nick Webb to the webinar. So you should be able to see him in the video panel there.
Morning, everyone.
Thank you very much for joining and sharing your wisdom and knowledge around these topics. It's been definitely questions I've had from family and friends and clients. What's going on, what to do in a bit of an uncertain, weird time that we're experiencing. Just having some insight into what you're about to share, I feel this is kind of like factual stuff we're going to go through that I feel gives a real sort of rational approach to, what is going on. So thank you very much.
No, you're very welcome.
Awesome. Just having a look at the people who've joined so far. I recognise most of the names here, but I will do a quick introduction to Inspire. So my name is Ben Walker, and I founded Inspire Life-Changing Accountants coming up 10 years ago almost in January. And to date, we've helped us clients save over $22 million and counting. So we're pretty proud of that stat. In terms of me personally, I mentioned I started Inspire. That was 23. I'm an award-winning chartered accountant, and I co-authored a book in 2018 called Cashed Up, which outlines the 7 steps for pulling more money, time, and happiness from your business. And just a quick intro to the people who are super important to me. We got Stevie and my 2 kids, Ezra and Rose there. That was on our little family getaway up the coast a couple of months ago. And we've got Mr. Nick Webb. So Nick is a certified financial planner and a director at RSM Financial Services, assisting clients with wealth accumulation, retirement planning, and self-managed superannuation. He's an experienced financial advisor. I've known Nick personally for over a decade, and he looks after my quite a few of my family members, including my parents, and a number of clients at Inspire. So a high level of trust. And on a personal front, Nick's a huge sports fan, ranging from golf to rugby and basketball. Look at that.
So all the things I'm not good at.
You prefer watching?
Oh, look, I like to play as well, but I'm not as good as I'd like to be, which is the case with a lot of things for most people, I think.
That's it. And I know you love golf. Awesome. All right. So we're going to have a run through what the agenda is going to look like for today. But a couple of things we're going to cover is, should I buy or sell? How to deal with inflation, and then also like dealing with this sort of debt and rising interest rates that is happening a lot, where we see the RBA meeting every month and giving it a nudge up. And before we get into the sharing, this is a compliance requirement. We don't normally see disclaimers on Inspire webinars, but this needs to happen when we're talking about financial advice. It's like a mandated requirement to share this. Don't take stuff out of context. And if you need advice, go and have a chat to Nick or a financial planner who knows their stuff. Cool. All righty. So first came off the rank, and please, I did say it earlier, please fill up the chat box and the Q&A box with questions, please. This is intended to be extremely interactive, and there's opportunity for lots of Q&A as we go. So I'll hand it over to Nick now, and I'll keep an eye on the chat box and that sort of thing. I feel I can see your question, but we'll come up with that soon. Thanks, Nick.
Yeah, no, thanks for that, Ben. Look, I think as Ben mentioned, I'd like to take sort of more of an interactive approach today. You only have to turn on any sort of media outlet, jump online, and, everyone's got an opinion on something, or someone's, pushing a narrative or a big slab of information. So I guess I wanted to approach today, in a similar vein to the way that I do with, friends, family members, clients, where I think there's sort of a big side of education around sort of making financial decisions. And, it's good and well to look at all of the, black and white sort of empirical data, but, really knowing how to apply that to your own situation and what that actually looks like. And I think that was the reason why I threw that first graphic up there on the right-hand side. And you're probably looking at it and you can't make heads or tails of what those little bar graphs actually mean. And I think that's so reflective of the finance industry. I think people, they've essentially based their careers off educating others as to what they need to do and how they can sort of navigate both through the good times and the bad times when it comes to finances. And that's really a large part of what a good advisor will do. In my mind, the end investment is very much sort of the last cab off the rank. It's very much about sometimes keeping people out of their own way, and sort of a shift in behavior, and using it as an advisor as a sounding board through times like these, especially at the moment where, it is concerning. And that's born out of the fact that I think every time we flick the news on, they're very much trying to push the narrative of scaremongering, because, that's what clickbait is. That's what gets the viewers. That's what gets the listeners. So, when we are just constantly bombarded with that negativity, it makes it very hard to know how to move forward. And it also makes it very easy for us to forget about all the good times we've had. So the graphic that I put on the side there, that's for me what the finance industry typically is, which is a lot of confusion. And I mean, really, when you break it down, it doesn't need to be like that. So I think one of the good takeaways when we look at that graph is, what that really reflects is, since the 80s, what share markets have done. And, when we look at that, ultimately 76% of the time, markets have been positive year on year. And, that's when we're in times like now, where we're in a bear market, where, major share markets are down 20%. We're feeling the pinch at the grocery store. We're feeling the pinch at the petrol pump. Everything sort of just seems to be going up, interest rates going up, mortgage going up. And, there's not really any wins around the corner. It makes us quick to forget that, really since 2008, when we had the GFC, which I'm sure a lot of you will remember, we've really had 13 years of good, solid growth in listed investment markets. Obviously back in March 2020, we of course had a bit of a hiccup there with, the semblance of COVID rearing its head. But I think, blink and you miss it, because there was such a downward drop in investment markets. But of course, they came back to normality and then increased past their previous highs, sort of no less than a month after that. So,
and I guess, Nick, just to touch on the point you mentioned earlier, when things go bad is kind of when we hear it in the news, rather than the celebrating along the way when it sort of picked up so much. But I think that's a really good point. It's almost like we need a graph along this line, or any other thing that shows market performance, to show when the media gets loud is only usually when it goes down.
Yeah, I mean, you only have to turn on the news when you when you hear about, let's say, for example, the Australian share market's up 0.5% today. The way that will get framed is ASX was up 0.5%. Whereas, let's say, for example, the ASX was down 0.5% today, they would form that in the view of a monetary figure. So, $500 billion bloodshed on the market today, when really it's gone down to the same amount that it could go up. So I think a lot of it is framing expectations and very much sort of looking at the long-term journey. And that's why this graph here, even though it's very complex on face value, the reason why it's important is realistically, if you were a gambler, you walked into the casino to play roulette, and as we know, you've got less than 50-50 chance when you play roulette. If someone were to put the odds in your favor and say, if we flip a coin, 51% of the time you will win, 49% of the time you will lose, you're probably going to take that bet. And in this instance here, 76% of the time you're going to win, and 24% of the time you're going to lose. So, I mean, it is very much an attractive investment, and there's a reason why listed assets, Australian shares, international shares in particular, ultimately, for the majority of the time, they will provide the best long-term return. Of course, in alignment, properties on that same level as well. But when you compare it to cash, fixed income, some of those more defensive assets, over time, they will always provide you with a better long-term return. But as the old adage goes, it's risk versus return. So you've got to be willing to go through times like we're currently going through to get that long-term benefit. Because if it was that easy and it was a risk-free return, every person on this call today would have every dollar that they own in the share market or in some form of listed asset that is going to go up and down. Because if it was risk-free, why wouldn't you go and try and get a 9-10% return on your money instead of 0.5% in the bank? So it's yeah, I mean, look, it's obviously topical at the moment because we're in a very interesting environment in 2022 where there really hasn't been anywhere to hide. Whether it's been Australian shares, international shares, even I saw a question here about gold bullion. Even gold has gone sideways and a touchdown in 2022. Cryptocurrencies, which I'm not a basher of either. I have some myself. They've taken a hammering this year. And then interestingly, your more conservative defensive assets, so fixed income and bonds, which is typically in a client portfolio or in a personal portfolio to, I guess, insulate away from some of that risk, they've actually taken a bit of a hiding as well because they're negatively correlated to interest rates. So what that means in practice is when interest rates go up, the value of a fixed income instrument or a bond goes down. So I mean, a lot of people are looking at, their statements at the moment or logging into their account and
seeing a lot of red.
Yeah, I mean, seeing a lot of red. And I think in times like that, just inherently in human nature, we're very hardwired to focus on the negative rather than the positive. So for me, when I'm talking with people that are very concerned about, where to from here, am I going to lose my money? And typically, as easy as it is to sit here and say, in an ideal world, times like these, you put your hand in your pocket and buy more of the same asset that you believe in. A lot of people do the opposite. So, it's the old saying of trying to catch the falling knife. When the market is falling, it's difficult to know where the bottom is. And I guess that's sort of a good takeaway that I'd like people to leave with today, in that, really, if you're trying to pick the highs and the lows, the best people in the world, they get it wrong day after day. So that really then moves away from investing and it moves into gambling. Last night, you just can't pick it. The US market was up between 2.5% and 4.5%. And that was on the back of a 75 basis point interest rate increase over there. So you'd think, why is the market going up when interest rates are going up, which typically doesn't bode well for share markets. So I think it's it's very much about just framing the expectation of what your objective is over that long term and how is it that we want to get there, and knowing that we're going to have times like we're currently having. And if you go to the next slide, Ben, we'll see over long periods, again dating back to early 80s, for example, as we can see on the right hand side there, the average bull period, which is essentially when there's a price increase of more than 20%, on average that goes for 7 to 8 years. And over that last 42-year period, we've had 38.5 years of positive times. Conversely, in a period like we are now, which is a bear market, that's the time when I guess it really separates true bona fide investors from sort of speculators, where people can't weather the storm. They feel as though the investment should only ever go up, and they start to get a little bit concerned that let's take an everyday name. Let's take the Commonwealth Bank, for example. You've put your money in there. Let's say you've invested $1,000. You bought 10 shares at $100. You're opening your portfolio today. it's down to $800, you've lost 20%. A lot of people have a knee-jerk reaction where they think, well, I've lost 20%, I could lose all of the money. And I think a lot of the time when I speak with people that are in that situation, what gives them some peace of mind is explaining to them that their investment in the Commonwealth Bank is a genuine investment in a company that, it has staff, it has revenue, it has a service offering, it has physical premises, it has profit. So for that share, which is now worth $80 to go to zero, which is essentially what needs to happen for you to lose the $800 left of capital that you've invested, the Commonwealth Bank essentially needs to go bankrupt. So I think when people get a proper understanding that the numbers they see on the screen are actually genuine investments in real companies, it gives them some more peace of mind where, if you look at your super statement, regardless of which provider it's with, or your own personal investments, regardless of what they're invested in within reason, it's easy to fall into that realm of just thinking their numbers on a paper. So, of course, in that notion, it makes it feel as though it could go to zero quite quickly. So, I think it's important for people to understand that uncomfortable times like we're currently in, they're always going to happen because that's just part of investment cycles. And I know one of the, the natural inclinations, as I've said, is we get into these tough times, people think is now a good time to sell. And, obviously Australians, just by our nature, we've got a great allegiance toward property. And, I think it's a good way to really compare the two where, ultimately, if someone were to come to me and say, Nick, I've got these investments, they're down 20%. All I can see on mainstream news is that, interest rates are going to go up. Are we in a recession? Aren't we in a recession? Things are looking really bad. We've got geopolitical risk out of, the conflict in Ukraine. We've got all the moving parts with China. And people start going, it doesn't really seem like a good time. And I think, ultimately, at the end of the day, if you compare it to your house, if your back isn't against the wall where you need your money and you knew that your house was down 20% in value, you're not going to go and sell it. That's really what it comes down to. If your house is fit for purpose and you know that it's down 20%, it's going to come back. The last thing really that you're going to do, unless you're forced to sell, is go and sell. You're typically going to wait until that property comes back to its original value, or you're just going to hold that because it has an intended purpose. And, I think ultimately you put that on the other side of the coin, people will typically go and do the other if they actually have the capabilities. So if they've got some money on the sideline, let's say they're looking at investment properties, or let's say they're looking at shares. If you're looking at one of these assets and let's say the cost is $500,000, that's what it was in December last year. Now we're sitting July, 7 months later, that same asset that is essentially, needs to form part of your portfolio and your objectives. If you can pick that up on sale for 20% off, you're going to be pretty happy to buy that. So I think a lot of the time it's just about really removing ourselves away from that hysteria of what's going on, taking a breath, taking stock of our own personal situation, and, just proactively working through that in a logical manner of, do I need to sell anything? And if not, do I have any money sitting on the sideline that I'm willing to invest into those same assets? And, frankly, when buying assets, there really should be a bit of homework or due diligence done on the asset you're buying, so that, if there is sort of market turmoil and you're invested in good assets that you've done the research on, that there's a compelling story why you've bought them. Let's say, you've bought CBA because you feel they're the best positioned out of the big four banks, or you've bought Qantas because you think it's, the premier airline in Australia and it's going to be okay. If those companies are still sound and they've just been, caught up in the market downturn, which has nothing to do with the company that you foresee moving forward, there's no reason why, you shouldn't feel as though you can put some money back into those investments if you feel comfortable in doing so. So I'm not sure if you want to stop for any questions sort of midway, Ben, if anyone's sort of got something on their mind, or if we want to keep, progressing through some of the slides.
Yeah. So, so Phil's got a couple of questions. And let me know if you'd prefer to answer them a bit later if there's something related. But what do you think of silver bullion as an investment at the moment for the next 3 to 5 years?
Yeah, I mean, look, commodities is an interesting one. The silver story's been sort of ongoing for a period where, I mean, realistically, by right, the silver price should be higher than what it is just based on the metrics and the analysis that's been done on it. Again, not dissimilar to a Bitcoin or to a gold. Really, it's just taking a bit of a punt on an asset class generally, and what you think, where you think that's going to go moving forward. I mean, obviously, the difficulty with something like a gold, a silver, a Bitcoin is that there's no income that comes off that. So if you're an investor that is chasing some yield and chasing some income, it's probably not going to be as good an investment for you compared to something that is going to pay you an income. However, if it's a hedge against volatility, or if it's a more of a long-term capital growth play, I think that it could have a position in a portfolio. What percentage is, of course, going to be solely based on, I guess, the other assets that you have within your basket of investments. If you're only sitting in commodities, then you're probably going to be pretty heavy in that space. So you may not want to double down as much. Whereas if you're currently sitting in, cash, fixed income and shares, and you've got no commodities exposure, then you may, of course, take a bit more of an exposure there.
Yeah, fantastic. Awesome. Cool. The next question is, and I like this because it sort of encourages people to understand where your experience is, but what do you personally invest in? And if you're happy sharing, what's the rough proportion between assets? So, residential property, commercial property, bullion, shares, and so on.
Yeah, absolutely. I mean, look, outside of my personal residence, I own commercial property, which for me, has been a good investment, especially because my own business was housed in that commercial property. So, I mean, look, for me, that was a really good strategy where I was my own tenant, my own landlord. Made a lot of sense for me. Strata titled office building, so it's not going to get a good amount of capital growth. However, it does provide me with a good income. And, most importantly, it was circumstantial for me. It provided me with a home for my business, and it meant I didn't have to deal with a landlord. So that was, I guess, a big compelling reason for that. Outside of, I guess, the commercial side, more or less 95% of my investments are in shares. And when we're not talking, speculative stocks, we're talking, for the most part, pretty wide ranging index investing, ETFs, managed funds. There's some direct equities that I have in different companies where I like the story, or I have a belief in what they're doing and think that they will be a very good long-term proposition. But again, for me, most of my investing is in much more diversified asset classes because, for me, I'm much more comfortable. Let's say I had $100,000, I would be much more comfortable putting that into a very diversified index or an ETF, knowing that if I get a 10% return, I make $10,000. I'm very comfortable with that risk compared to taking $10,000, for example, investing that into a single stock and hoping for 100% return to also make $10,000. So either way, the net return is still $10,000. However, one, you're taking on a lot more concentration risk. And, for me, I'm happy to put a large chunk of my wealth into diversified indexes and diversified managed fund providers, knowing I can sleep straight at night, because the largest exposure I may have to a single company, is going to be quite inconsequential. And that's why, the ASX is an interesting one, because just how shallow our market is with some of the, call them mega cap stocks if you like. But if, at the moment, if you put $100 into the ASX, over 10% of that's going into BHP. So you put BHP, Rio Tinto, and the big four banks in the mix, and over a third of your capital is invested in 6 companies. So it's good to look at different solutions out there. But I guess going back to overall asset allocation, outside of that commercial property, probably 95% of my assets are in shares, and then I've got a holding in cryptocurrency as well. And again, for me, some people may celebrate that. Some people it may be frowned upon. I'm a big believer in having diversity and a well-rounded portfolio. So I'm not going to go and have 50% in Bitcoin. But by the same token, I don't feel it's fair for me to sit on the sidelines and not have any exposure. And, people will look at my portfolio and say, it's very aggressive. And I mean, it is. And I mean, ultimately for me, I'm happy to take on that risk, because ultimately for me, I know if you're in sound assets, the more aggressive that you're investing in shares, for example, comparative to, fixed income, cash, and some of those more conservative elements, it's going to outperform long term. And for me, I'm looking at it as a long term. I still to this day, clients ask me what the key is to really getting ahead. And the best thing that I ever did was every month on the 15th, my account gets debited, goes straight into a diversified portfolio of shares. I rarely look at it. Times like these, I celebrate because I'm buying the same thing that I was buying last year, but I'm now getting more units every month because I'm buying at a 20% discount. So, it's a strange thing to think about, but for my clients that are accumulating, and, superannuation is a big part of that, because really, the vast majority of people are employees. They don't have a choice with regard to superannuation. So that money is always going to be going in. So realistically, volatility is your friend, because you're buying the same asset month after month or quarter after quarter, depending on when your employer is putting that money in, and you're getting it on a sale price. Whereas if you're on the opposite end of the spectrum, where you're not adding money to your investments, you may be retired, you're pulling money out, you don't want to see volatility. You want to see a straight line where the value of your assets are only going up because you're constantly pulling money out. So I think it's, it's very much horses for courses, where everything that is done needs to be bespoke for you, your circumstances, what stage of life you're in. An aggressive portfolio for someone in their 20s or 30s is, of course, going to be a much better fit than it is for someone that's in their 50s, 60s, or 70s. So again, it's very much circumstantial, and it's objective based as well. I mean, if you have, let's say I had a large windfall, I go and win the lotto, and I needed 2% return to fund the income I need forevermore. I mean, really, even though that it's going to provide me with the best outcome, I probably wouldn't go and invest it the way I have now to get 10%, because I don't need to. But then, and it's the other side of the coin. If someone's got $100,000, they want $10,000 of income a year. They're not going to get that unless they're sitting aggressively in growth assets. So it's just about weighing up that risk return versus your own personal circumstances and what it is that you're trying to achieve there.
Beautiful. All righty. And are you aware of any major changes affecting SMSF superannuation, so specifically SMSFs, coming up?
Look, I mean, nothing that hasn't really sort of reared its head since May budget. I think, obviously the Labor government is preparing for another sort of out of cycle budget in October. So we may have a few different triggers that get pulled there. But typically, I don't think midway through a financial year there's going to be any large scale changes. For me, when I look at self-managed, I sort of encapsulate that into the whole superannuation environment, if you like. I mean, obviously there's some intricacies around, the amount of members that you can have in a fund and things such as that. But for the most part, we really look at the governing legislation with regard to, when you can access the money, so your preservation age, how much income you need to draw if you are past your preservation age and you're drawing income, how much money you can get in every year if your employer's putting money in, or you're working and, you know, salary sacrificing or putting personal contributions in, because those are really the big triggers that the government, you know, tinkers around with year on year. You know, we haven't had any changes for a little while, for the sort of last 18 months since, you know, they introduced a few different measures around, you know, larger amounts you can put into super each year. But, you know, ultimately that does typically flow out of, the May budget. So.
Yeah. Okay. And I was at a brekkie a couple of weeks ago with some like a tax expert from Chartered Accountants, and he was saying, like, he works with government quite regularly and gives them the feedback on stuff. His feedback was the October budget, we're probably not going to see too much rocking of the boat. You know, Labor's just been voted in. Don't want to piss too many people off. But they may be conditioning us in that budget for something, you know, some larger changes in March next year. And that normal one, is it May or March?
Yeah, I mean, like it typically flows out. Well, they typically start floating ideas in March, and then it comes out sort of through May.
That's it.
One of the, you know, one interesting thing that always comes across my desk with sort of new clients, I guess, is that somewhat of an aversion to superannuation, because there is, you know, the fallacy that the government's going to tinker around with it. The government's going to, you know, increase tax, or the government's going to lock it away. And I mean, look, you know, the government has changed things in years gone by, and that's a valid concern. I think for me, sort of the ironclad answer I typically have is, you know, superannuation itself, people need to remember that you can invest your superannuation however you like. So that's not the investment itself. It's solely just an environment. So, you know, you can have 100% of your assets sitting in superannuation in cash. You can have, you know, a large amount in property if you're in self-managed. You can have, you know, what the previous question was, you can have it in, you know, bullion, physical or listed. But ultimately, the main premise behind superannuation is that it's going to be the most tax-effective environment for you. And that's essentially the backbone of the superannuation industry. So when people come to me with their concerns that, is the government going to change the taxation regime within super, my typical response is, you know, sure, that could be, you know, that could be on the horizon. That could happen, you know, during our lifetime. But what I know is that it will still remain to be the most tax concessional environment, because if it isn't, it completely undermines the whole premise of having superannuation in the first place.
Yeah, no, very good. Awesome. All right. Well, we do have another question, but let's jump through maybe a couple more slides and we can round up some more Q&A towards the end. The age-old question: should I buy or should I sell, or should I buy the dip?
Yeah, I think, again, like this is a very important one. And look, again, the disclaimer here is it of course depends what assets you're invested in, because you know, like, let's say, for example, I guess it brings that concentration risk into play again. But if you you know, look at some of the darlings through the COVID period, so if you look at the Zooms, you look at the Pelotons, some of those companies are down anywhere between 50 and 80% since their highs last year.
Ouch.
Whereas if you look at the wider S&P 500, for example, where those companies are listed, as we sort of illustrated previously, it's in bear market, which means as at today, it's down about 20% in the current calendar year. And, you know, obviously you'd much prefer to have a loss of 20% as opposed to 80%. But I think something that is important to remember is we always tend to have that reversion back to the mean, which is why, you know, as we look at long-term historical returns of Australian shares or international shares getting up near, you know, 7, 8, 9%, you've got to remember that to get that 7, 8, 9% on an average basis year after year, you need to have a good recovery following on from a decline. And so what we've got up here on the screen is essentially what it looks like. So a period like we're in today, and of course, you know, history is going to be the best measure for what comes next. I don't have a crystal ball. I wish I did. But ultimately, if you look at all of the bear markets that we've had since mid-50s, so we've got data dating back 65 years. The average return on your money invested in the American S&P 500 index has been close to 24% the 12 months following a bear market. So let's say, for example, we started to post a recovery today. If we were looking solely at past periods following on from periods like we're having in 2022, the average recovery 12 months following today would be more or less 24%. And that's not to say that that is what will happen, but I think, if we look on the slide there, we've only really had one or two periods where it hasn't been a positive period, 12 months following on from a bear market. So again, if you were just a betting person purely based on probability and statistics, it looks like a pretty attractive investment. So I think, ultimately for me, I'm a big believer in maintaining conviction in the assets that you have, especially if they're more broader type investments like the S&P 500 index. And, I think the best investor in the world will, so he's claimed Warren Buffett. One of his sort of sayings is, for the ordinary person, the best thing they can do is go and invest in an index of American stocks, because a lot of the time, I think it's sort of, analysis paralysis, where people get so caught up in, do I buy Zoom? Do I buy, Afterpay when it was a thing? Do I buy, Commonwealth Bank? Or do I buy the miners? Or do I buy this, that, or the other? And what ends up happening is there's so much information and so many choices that they end up taking no action. So I think a good thing to do is get into a regime where, an index is going to be fine for the majority of people, where, if you turn on the TV, the Australian market's up 2% today, your portfolio is up 2%. If it's down 0.5%, you're down 0.5%. It's just good long-term growth, compounding returns on top of compounding returns. And for 99% of people, that's going to do a far better job than what it is they're currently doing, which is typically nothing.
Fantastic. A very good point about that. If you're just so overwhelmed by choices or decisions, just ending up doing nothing, then you miss that return. I've seen that way too many times.
Yeah, absolutely. I mean, look, it's just the cost of leaving your money where it is. And, now this slide is sort of more important than ever, because we're in a period now where, obviously inflation's the buzzword, and, you've got the best experts in the world. They can't even agree whether we are in inflation, whether we're heading into an inflation period, or, whether we're in a recession. So, I thought this one was a bit of a laugh, which I saw yesterday, and it was, from the White House. So, I guess one of the most respected bodies in the world, you would think, that they themselves essentially can't even come to an agreement on what a recession technically is. So, it's quite easy to say we're not in a recession when you want to go and change the definition from an economic standpoint as to what a recession actually is. It's probably similar to looking at different countries around the world that have some pretty interesting GDP figures that get printed each year. So I guess you take it with a grain of salt. But what I do know, and what I'm sure everyone else on this call would know at the moment, is, there's no if, buts, or maybes that things are getting more expensive at the moment, whether it's, go and fill up the car, go and get a gas bottle for your barbecue, or, for your hot water system, whether you need to travel somewhere, whether you need to go to the store, buy some groceries. It doesn't really matter what it is you're doing. The cost is going up. And I guess the biggest thorn in the side at the moment is interest rates going up, and, mortgages would be everyone's largest expense. And look, I think it's easy to complain about the state of affairs, but, realistically, when we get into periods like we are in now, it's very much about how do we preserve what we've built, and how do we weather the storm and get through the other side. A lot of that preparation needs to be done before the fact as well. Realistically, if we're sitting there with interest rates I mean, official cash rate sitting at 0.1%, you know, in 2021, you have to think, well, you know, mortgage rates are essentially solely reliant off the RBA cash rate. So if we're sitting at 0.1%, really, it's not going to go down. It's going to go up from there. So I think at the moment, a lot of people, I don't know if surprise is the right word, but there is definitely a lot of pain being felt with the interest rate rises because people have, you know, potentially bitten off a bit more than they can chew. You know, wages growth is certainly not keeping pace with the inflationary pressures we're seeing. And, you know, I guess that's what the RBA is really trying to curb by putting those interest rates up, which a lot of people will think, you know, we're really feeling the pinch now. We're dwindling our savings, costs of everything's going up. Why are you putting the cost of our mortgage and everything else up? And the whole reason they do that is they actually want people to stop, you know, spending in the manner that they are, so that there is a bit of a softening from the inflationary side of things. So that will have a flow-on effect to property. That will have a flow-on effect to the petrol pump, to the groceries that you're buying. And, you know, I think speaking of groceries, that's a really good segue into, you know, what do you do at the moment from an investment point of view? And I think, you know, as I said, I'm a big believer in having a good amount of diversity. I do have, you know, clients, friends, family that still like to try and pick individual winners. And, you know, you go, okay, well, we're in this period now, you know, who's going to be the loser? Who's going to be the winner? And if you look back over history, you look back at the basic economics of inflation and how that, I guess, relays into investment markets. If you want to go and do individual stock picking, you know, it's really about finding stocks that have some pricing power where, you know, they can quite easily push their price up, and, you know, really the consumer doesn't have a choice but to cop that on the chin and pay for it. So, you know, if you think of your grocery stores, so Coles, Woolworths, if you think of, you know, insurers, for example, Suncorp, IAG, and this is not advice. This is sort of just, you know, my opinion on.
I'm writing them down.
Yeah, I mean, it's who would be best to sort of, you know, battle the waves of inflation.
Yeah.
Someone's mentioned electricity companies. That's spot on because they, you know, monopolistic. They're a necessity for people. They can pass the cost on, and, you know, Ben Walker's not going to say, well, you know, I'm not going to pay my Origin electricity bill. I'm going to go without and sit in the dark because they put their price up 15%. It's, you know, really, it's a necessary evil. You're going to pay for that. Whereas on the other side of the coin, you take some individual companies that, you know, they're heavily debt laden. So they're, of course, their earnings and their longevity is essentially going to be very much dictated by rising interest rates. So a lot of the tech companies, and that's why, you know, if you look around the world at the moment, the companies that are really, I guess, the most volatile and that have taken the biggest hit over the last 6 or 7 months are your tech companies. So, you know, you look at the likes of, you know, your Snapchats, Meta, you know, Tesla took a bit of a hiding there as well. Just companies where they are carrying a little bit of debt, and, you know, they were the darlings sort of 12, 18 months ago, had this unprecedented amount of growth. And yeah, I mean, now they're, you know, they're starting to struggle. And I guess, you know, that's just the nature of investment cycles as well.
Yep. We've got an inflation related question. So how does QE, or money printing, and QT affect your decision making about what assets to purchase?
Yeah, great question. You know, and that's an interesting one at the moment, is because there's so much money out there in the system. I think, you know, the official figure out of the US was that, you know, in 2021, they printed essentially 40% of their total currency in circulation. So it becomes a big problem. I mean, you know, that's why we see so many of these inflationary spikes at the moment, because, you know, people are spending like drunken sailors because there's so much money that's being printed. And, you know, ultimately, again, what that does is it very much goes and devalues currency. And, I think it's about looking at different opportunities across the globe as well. So looking at in some countries where they haven't printed to the same extent as places such as the US. And, I think in periods like we're in at the moment, domestically, Australia is even though it is a shallow market, we've got a huge benefit from, very high dividend or income paying stocks. We've got the benefit of franking credits as well, which makes it a little bit nicer on the top line from a return perspective. So, yeah, I think when we're looking at QE and tightening on the other side of the coin as well, it's very much just taking a broader macro view as to, what does that flow through to? How is that really going to impact upon listed investment markets and other investments that clients will have in their portfolios, such as, direct property or any unlisted investments that they have as well. But, typically, jumping into that commodity space for a lot of people is, they like that because, there's a finite supply of things like gold and silver, whereas, when you turn the money printing press on, there's an infinite supply of currency. So, yeah, I think it's just weighing up, the current state of affairs and where to from there.
Cool. Alrighty. We've got two questions that are related to property, but I think before we get into those, we've got one last sort of slide on about interest rates.
Yeah. Again, it's living within your means. I mean, obviously, I'm not here to chastise people and sort of, slap them over the wrist and tell them how to live their life. But of course, it's a sort of foregone conclusion that you need to live within your means. As a mortgage holder myself, I absolutely detest, seeing my interest rate with my bank higher than that of a new customer that's advertised on the internet. So, in this day and age, there's absolutely no benefit in being loyal to a bank, especially one that you've got your mortgage with. So for me, I'm not a mortgage broker myself, but I'm a huge advocate in using mortgage brokers. So, I'm going through that process at the moment of refinancing my property because I'm not happy with the interest rate that I'm on. And, I think we're in a period of competition. The banks want you as a consumer. There are some, nice sort of sign-on bonuses or interest rate savings. So I think it's really about going through that process and engaging with with a qualified broker that can tell you what you're paying, tell you what the options are, maybe even take you through a journey where you may have some lazy, more expensive debt, whether that's credit card debt that you can't pay off, whether that's, personal loans that you haven't paid off, where you can, essentially try and package that all into one and have a lower interest rate across the board on all of the debt that you have. So, for me, I really think you need to sort of go through that exercise, and again, myself personally, I knew that it needed to be done. It is sort of, you do need to do a bit of heavy lifting. So it typically falls to the bottom of the pile because you know that you need to do some work. But I think it's, going to be your biggest expense outside of your ordinary living expenses. So it's pretty important to get that one right.
No, absolutely. And then just jumping through those couple of questions, and we've got probably about 7 or 8 minutes left. Do you think buying an investment property is a good hedge against inflation? Sorry, that's a bit of an inflation and property question.
Yeah, that's okay. Look, again, depends on the market. Look, I think generally, it's going to be difficult because if we're in an inflationary period, the cost of everything's going to go up alongside that. So, if we're in an inflationary environment like we are now, where interest rates are rising, obviously that's going to cut into the net return on your investment. If again, it's all very much based on the pocket that you're investing in. I mean, at the moment, I'm in Brisbane. I know Ben's in Brisbane. The rental market is very, very tight. So if you're a landlord, there's absolutely no problem getting a tenant. So, in that realm, sure, it's going to give you some income. If debt goes up, it's going to cut into your net return if you've got a mortgage on that investment property, but still, you're going to get that benefit of some income where, if we're in a period where there are some inflationary pressures, but interest rates are going down, as an example, there may be more supply out there. People have bought houses. You may be left, holding the can without a tenant. So, it's very much based on your own circumstances as well. I mean, if you're essentially sitting in an environment where you own your personal residence or you have debt against it, that's going to be your largest asset. Outside of that, if you don't have any diversity across other markets or across other assets, I would be hesitant to go and buy more, domestic, especially if it's in the same location as your personal residence, because then ultimately you've really just got all your eggs in one basket. And like, I love property because you can leverage and you can get an income as well. The difficulty is, it's very much an all or nothing. You have, stamp duty expenses, you have agents' fees if you need to sell it. If you ever get pushed into a situation where you need to call upon money, it's not like a listed asset where there's a primary market. You can sell 1%, 5%, 10% of your investment. It's very much you sell all of it or you sell none of it. So again, it's, if you're only sitting there invested in equities and you've got no exposure to property, well, then of course, I'd sit there and say, I think you need some exposure to property because it forms part of a good diversified portfolio.
Awesome. Okay. And then what about if we compare that to commercial property at the moment?
Yeah, look, I mean, commercial, this is an interesting one. I mean, I own a business, own commercial property, and, in business also rent from landlords and other properties that I have as well. So, you go back to March 2020, you look at different offices, you look at different companies, some of the large ASX listed companies here in Brisbane, they had, 3 or 4 full levels in town. There was the whole conversation around working from home. What does that look like? And sort of that very accelerated shift toward remote working. So some of them, they were set to take out a 5th level, and they actually went the other way around and went from 4 levels down to 2, to then only get to a period now where they're scrambling, hand over fist to go and get some commercial space because people want to be back in the office. Things are returning to some sense of normality. Look, for commercial property, for me, I'm of course a bit biased. If you're your own tenant, I always think it's a great option. I like commercial property because, unlike a residential property, essentially you have a tenant that's operating their business from your commercial premises. It's typically for a 3, 5 or 7 year lease. They typically take a lot of pride in that premises because that's how they generate their livelihood. Whereas if you've got a residential property, it's typically a tenant, they're turning up for 6 to 12 months. They turn up with a suitcase and a couch, and, really they don't give a hoot about the property. So, of course, it goes both ways. It's of course then more difficult to get a commercial tenant, but once you do get one, it's, obviously going to have a bit more longevity there for you as well.
Yeah, cool. Alrighty. And then one last question, it's still on the property train, but it's around investing in offshore property. So as a consideration to hedge against property prices and currency rates. Yeah,
good question. I'm married to an American, so I look at the American property market quite a lot. I think what's precluded me from doing it is, I mean, look, there's obviously so many considerations and how you own that. For me, I'm much more comfortable going and buying some sort of listed property globally on a listed market, so I don't physically own the property itself. Even with me having family in the US, it's very difficult because there is a big currency consideration. I mean, look, the Aussie dollar against the US has been hammered in the last sort of, 6 to 9 months. So not only are you navigating that, you've also got, let's say I own a property in, I don't know, Boston over in the US, and, cost me $500,000. I've got a tenant in there. The agent calls me up look, you need a new hot water system in your property in Boston. Really, whether you need a hot water system or not, you've actually got no idea. So I think, it's very much out of sight, out of mind. You somewhat lose a bit of control there. Obviously, there's different legislative arrangements, taxation arrangements internationally as well. And, I think what I sort of said to my wife was, as long as we're living in Australia, we'll invest in Australia with, physical assets. Listed assets, I'm, of course, happy to buy all around the world. And then conversely, if we're living in the US, I'm happy to buy investments in the US, and I wouldn't buy physical property in Australia. So I guess for me, I'm a bit simplistic in that I feel for the majority of people, the return objectives they need to achieve, they can do them in a very black and white manner without needing to take on excessive risk or, intricacies of investments that they don't need to.
Yeah, absolutely. And how do you feel? Sorry, mate, we've got to wrap up. We saw that question on the interest rate, but maybe we can connect offline on that one. All righty. Well, hey, thank you, Nick. I really appreciate you sharing your knowledge, and I think you've done a great job in answering those questions. Especially with a whole heap of unknowns. And just sharing that, going back, if we look at what happened since the 80s and, all those sort of bear markets we've seen, it's actually not the doom and gloom so much that you hear in the media. So really appreciate that. And thanks for joining.
No, you're very welcome. Hope that was helpful for people.
Yep, absolutely. I got heaps out of it. And in terms of just wrapping up the webinar, if you'd like to sort of hear more of the little snippets of education we share, give us a follow on all the different social medias. We do have the webinar replays that go live on YouTube as well, and we'll send that out to anyone who's recorded. So thanks again for giving up your Thursday morning to join me and Nick, and appreciate that. If you aren't currently working with us as well and you'd like to have a chat with one of our accounting team or want to get in touch with Nick, feel free to do that either by looking up Nick at RSM, or we can do an introduction if you're currently working with us, if you'd like to have a chat with him. If you're looking at sussing out a new accountant, then booking a strategy call is the next best step with one of our accounting team for that. So thanks again. And we will see you at the next webinar.